Hi, I'm Max Keiser. This is the Keiser Report. You know, we're going to count down the next few shows toward an historic day in monetary history. That would be August 15th, 1971, the day that then President Richard Nixon closed the gold window, basically defaulting on America's obligations to Great Britain at the time. And since then, we've had pure monetary chaos. Stacy.
Yes, that was known as the Nixon Shock, and that's where you can find it under Wikipedia. It's a research that over the next 2 weeks, we're going to be looking at that, building up to this 50-year anniversary of a great monetary experiment. This is a monetary experiment, right? Because this is the first time we've had a global all-fiat world based on basically nothing but paper, backed by, as Paul Krugman at the New York Times, a Nobel economist says, backed by men with guns. That's a first. We've always had hard money or hard wealth creation, real wealth creation. So this is the first time we've had been beyond that sort of a system. So it's an experiment. We're 50 years into it. And that's kind of what the Keiser Report has been doing for the past 10 years, is kind of cataloging the results and the consequences of this. We're researching the experiment.
Right, so there's two parts to it. There's a monetary relativism, which is that fiat money in one country was valuable relative to the fiat money in other countries.
Yeah.
And so that entered into an era where value, a standard of value, became almost impossible to acknowledge or maintain. The other thing it led to was that previous to this, central banks were somewhat autonomous and obliged to perform in the interests of the countries that they were in. You know, the Bank of Japan, Bank of England, Federal Reserve Bank, European Central Bank, are the precursors to the European Central Bank, and all the various European countries would be involved in policies that were seen as beneficial to those countries. After the Nixon shock, and for the past 40, 50 years of deregulation, we've seen collusion, as Nomi Prinz writes in her book called Collusion. And this is about how central banks now work in concert with the same expansionist policies. And so the same problems are now being experienced in all countries.
Here's a headline that, to me, the two words, no resistance. It's a fantastic way, I think, to describe the results of this experiment, what this experiment has caused in terms of the psychology of the population. And this is the headline from wolfstreet.com, no resistance to price increases. Reports are coming from all directions, from small mom and pop operations to large corporations. Input costs are surging. Wages that companies have to pay to attract workers are rising. Transportation costs are surging amid driver shortages. Supply chains are tangled up, and there are delays and bottlenecks, and suppliers suddenly can't deliver because they've run out of something. And companies are furiously juggling these issues, and they're raising their prices to make up for those higher costs. And there is no resistance to these higher prices. Consumers are willing to pay whatever. Usually there's resistance over the past few decades, and companies have to do whatever it takes to try to figure a way out to reduce their own costs in order to keep the same price for their customers.
Right. The last time we had resistance was back in the late 70s, early 80s with Paul Volcker, who was running the Federal Reserve at that time. And after Nixon let the genie out of the bottle, Paul Volcker had to raise rates to very high mid-teens to form some resistance or to create some scarcity. We have had, since Paul Volcker in the age of Margaret Thatcher and Ronald Reagan and the era of deregulation, this runaway derivative growth that has created what's called the shadow banking system that's not accountable to anybody. And periodically you'll have crashes, and that's where the resistance comes in, whether it's the crash of 87, the bond crash of 93, the subprime crisis of 2008, et cetera. That's where the resistance is. And even Alan Greenspan said that Fed policy is no longer to try to manage the economy, it's merely there to clean up the mess after the crashes, which is what he said. But this idea of creating artificial shortages or artificial scarcity, and you could encapsulate that in the work of Milton Friedman in the monetarist school out of the Chicago School of Economics. That has now, I think, come to the absolute screeching halt. We now have runaway inflation from decades of money printing, and the bodies are now surfacing. They can't bury the bodies. They can't hide it anymore. There's no more hedonic adjustments. And people are starting to realize it, and it's happening on a global basis, which leads to the famous phrase uttered here on this show by Max and Stacy, global insurrection against banker occupation. It's now global. It's now here.
The other thing I want to consider, Max, is when we've talked about this, that the stagflation, the inflation happening right now is similar to the 1970s. But the thing that's different is, of course, the new generation. The boomers were the young generation, the equivalent of Generation Z back then in 1971. Now we have Generation Z and the younger millennials at the same age. So back in the 70s, of course, you were coming off the hippie movement, the resistance movement. Everybody was resisting the draft, and it was all about free love and stuff like that. Now we have no resistance. So where are we from that point of view? Because back then, the boomers were born and raised in a time of wealth creation, rising wages, rising real wealth, a manufacturing powerhouse. And now we have a generation that was not raised on that sort of economic model, was not raised on a gold standard. They were raised on more of, a Zynga sort of gaming, like virtual reality platform and economic system. So whereby like these Biden bucks, before that was the Trump dollars, the stimulus checks, the stimmies, like the no resistance to price increases makes sense in a way in that they don't have that same understanding of the economy and monetary policy. They feel like, on their games that they play all day, it's easy to just credit your account with more new Linden dollars or whatever it is,
Right, you mentioned Zynga there. They were the company behind Farmville. Farmville was one of the early applications or games available on Facebook, and it really made Facebook, get that first 100 million users or so. And absolutely right. So virtual reality, virtual economics, virtual currencies is where this generation is most familiar, and that's their understanding of economics. And people often say that life is all about powering up. And like in a game, a world of witchcraft where you get an extra sword, you get an extra weapon, and that's what people understand to be the economics. What we're seeing now is the difference between inflation and hyperinflation. So inflation is a monetary event, hyperinflation is a political event. And when people lose confidence in the funny money, the game currency, the US dollar in this instance, then you get hyperinflation, which is absence of confidence in the dollar, and we see that in other currencies. Because the dollar is world reserve currency, it has other complications involved. But at this rate, I think on the 50th anniversary of the US dollar in its pure fiat form, going back to 1971, August 15th, what we're going to see is a collapse.
So there's no resistance to the price increases, certainly not from this new generation, the Z, millennial. They're out there and happy to pay these price increases. All value is subjective. If they feel like these virtual currencies are good enough for them, that's one thing. But the problem is when you do actually need real supplies, like you do need food, you do need somebody to actually go out there into the field, plant the seeds, hedge their risk, reap the harvest, do all that stuff and deliver it to you. So in the 70s, and we're comparing these two generations because in the 70s is when the Nixon Shock happened, 1971. 50 years later today, we're having another supply shock. The supply shock back in the 70s was the oil embargo that first started. We had one in the early 70s, and then we had the Iranian Revolution in the late 70s. So we had these all these supply shocks, or the second one was a fear of a supply shock that didn't actually materialize. But now we have a supply shock similar in the U.S. with various goods, including agricultural goods. So you're seeing all the restaurants, the fast food chains, even having to pass on huge costs to their consumers. There was a recent call with Chipotle, and they were mentioning that they raised their prices by 3.5% to 4%. Classic sort of fast food chain that is beloved by millennials and Generation Z, and they raised their prices by 3.5% to 4%, as the earnings call just last week said. And they were surprised, no resistance at all. The consumer is willing to pay. And they were kind of suggesting there might be some more increases coming very soon. The meat prices is the other thing, and this is where you're seeing a shortage in supply. There is plenty of meat itself, but meat packers are having one heck of a time hiring staff and filling orders amid red-hot demand, particularly from the restaurant industry, and suddenly meat prices are jumping. Even the Bureau of Labor Statistics picked up on it with its CPI report for June. The price of uncooked ground beef, for example, jumped by 3.4% in June from May. Uncooked roast jumped by 5% and steak by 6%. Pork chops, roast, and ribs jumped by 5%. So, of course, they lose control of their hedonic adjustments, right? Because ground beef, of course, is always the classic hedonic adjustment for steak. Steak prices are up 6%, so people are just going to replace it with ground beef. Instead, ground beef is also up 3.4%.
Right, and they're trying to replace ground beef with bugs, right? Let them eat bugs.
Yes.
Right, well, no, this is a definition of a classic Ponzi scheme. And we have what are called the good Ponzi schemes. People would describe America's Social Security system as a good Ponzi scheme, right? The young people paying into it today are the ones who finance the retirements of the people retiring today. And that's essentially a Ponzi scheme, right? You're living off the new money coming in. But it's called a good Ponzi scheme because there's nobody losing until the pot of money in Social Security would run out. Then the whole thing would collapse. Well, because we've got a situation now where the money in the Social Security scheme is running out and it is about to collapse, you're going to have a catastrophic event happening in America's safety net, as we see in Social Security. But as you're describing it in the supply chains and the basic underlying cause of inflation, it's a similar Ponzi scheme. And people who are getting the stimulus checks are participating in a Ponzi scheme. They're getting free money from the government to buy overpriced meat. As long as that free money keeps coming in on the Ponzi scheme, then this Ponzi scheme is a good Ponzi scheme. This is, of course, contingent on one major factor in the global geopolitical arena, and that is that China continues to finance America's economy. As long as they continue to do that, all is great. But last I checked, there seems to be some acrimony between these two superpowers. Maybe China won't be financing America's economy much longer.
Well, the Nixon Shock started in 1971. We're going to be covering that for the next 2 weeks. Here, we have a situation whereby as these prices increase, I think the money printing will have to increase, the stimulus checks will have to increase. So we'll see how that goes, whether we're going to get more and more high inflation, super high inflation, like double-digit monthly inflation like we had back in the 70s. So that's something we're going to cover for the next 2 weeks.
Right. Many more of these shows will, in fact, be inflating. All right. Don't go away. Much more coming your way. Welcome back to the Keiser Report. Time now to go to Craig Hemke of TF Metals Report. Craig, welcome back.
Always good to see you, Max.
We're talking about Richard Nixon, one of the previous presidents of the United States. You know, back 50 years ago, he closed the gold window, and we entered a new era of a pure fiat money standard around the world. What are your thoughts on this so far?
Well, I suspect you've discussed the history of it and why, right? The world was awash in dollars, rebuilding back from World War II and then the Great Society and everything else that Johnson did. And all of a sudden, people wanted to switch, like de Gaulle, the French in particular, wanted to switch their dollars back into gold. You know, $35, get an ounce of gold. And that became untenable. And the U.S. was losing all the reserves. And so what did Nixon do? He just suspended, Max, it's officially just suspended, right? The convertibility. You know, the first thing that comes to mind is I remember a day, just as I was getting started doing this, like at about 9 or 10, and I was talking to a buddy of mine who I'd been friends with since I was a teenager. And we were lamenting how hard we worked and how much money we made, but yet we still didn't have the lives that our fathers had, our parents had. You know, my mom and dad in the 70s, you know, my dad maybe made a couple $1,000s a month. My mom didn't even make that as a teacher, but yet they had a nice house. It belonged to a country club, put all the 4 kids through college. And you can never do that today. And what got away from us beginning in the 70s. You can trace all of the income inequality, all the wealth inequality, all the stuff that the politicians blame on each other and blame on you and I. You can trace it all back.
Yeah, what's interesting, Craig, is that for 50 years, the world's been on a fiat money standard, and there's been no hard money in existence. And then on the 50th year of this experiment, one little country in Latin America, El Salvador, has now bucked the trend, and they've gone back to a hard money standard. They've introduced Bitcoin as legal tender. Do you see that as being the spark to start a bonfire that will burn down the fiat money central banks?
Yeah, they got started first, no doubt about it. What will happen one day? And again, one day. What does that mean? But the fiat system exists on confidence, right? That's why they backed the dollar with gold in the first place, coming out of World War II, to give everybody confidence that you could trade in it, hold it, is as good as gold. It still exists on confidence that it's worth something, but eventually you print so much of it that everybody loses confidence in it. That's when you get to the Weimar style hyperinflation, right? You have no confidence anymore. And it just, you demand more and more of it because you don't know where it's going. And then the whole thing finally blows up. And so how do you reinstill confidence in your currency so that people will use it and you get the economy moving and you back it by something? That's how it's always worked for centuries, millennia.
You make a good point there, Craig, and that it's about confidence. And the people in Washington and at the central banks think it's all about policy. And they don't understand that once the confidence changes, there's no policy in the world that's going to change people's panic buying out of fiat money into something that holds its value. Now, the FT, the Financial Times, recently wrote, quote, "Let's all please stop calling dollars fiat money. Currencies are not memes that only have value because governments say they do." Your response?
Here it is again, confidence. They have value because governments say they do. And again, that works until it doesn't. It's like the old Hemingway line, right? About how'd you go broke slowly and then all at once, right? How did you lose confidence in your fiat money structure suddenly and then all at once? It leads me to another thing, Max, that's all part of the scam, if you will, is when you quote the dollar, when you watch mainstream financial news and they say, oh, the dollar was stronger today. Well, they're referring to the dollar index. And what's the dollar index? It's a basket of other unbacked currencies like the euro and the pound, the yen, and you name it. And so when the dollar gets stronger, it's only relative to these other fiat currency. They're all devaluing the same way. And so when they all devalue at the same rate relative to each other, they don't change. And that's all part of this kind of confidence scheme they're running.
Yeah, President Joe Biden recently came out and said that his stimulus package that he's introducing is not inflation. And the reason why he believes it's not inflationary is because Moody's, the rating agency that's owned in large part by Warren Buffett, who just had to settle a corruption charge involving his company and Moody's, told him that it wasn't inflationary. What is he getting wrong?
Everything. I guess I'll put this in that larger picture. Whether it's the President of the United States, whether it's all the bankers, whether it's Warren Buffett, they all have an obvious interest in perpetuating the system as long as possible, right? Because the U.S. has to maintain demand for dollars if we're going to be able to continue to service all of this debt that we've, built up $30 trillion, and everything else. And so they're always going to go down that road. It's all part of the government statistics. That's why they understate inflation. That's why you can get all the way to today with transitory inflation and how the Fed is trying to jawbone yield curve control by convincing everybody that inflation is going to go away. It's all part of this spin cycle that everybody with a vested interest in perpetuating the system supports. And that's Biden and everybody else you just mentioned, Max.
Inflation is raging. The Fed's balance sheet is soaring, and yet precious metals are flat. What's going on?
Again, remember, how do we determine price in precious metals? And how have we determined price since 1975? Okay, this all goes back as a direct result of Nixon going off the gold standard too. We determine price through the trading of derivatives, and where each ounce of actual physical metal is levered 100 times, 200 times. I just saw a thing today. The volume of silver derivatives traded in London is 270 times the amount of silver that's mined every year. Okay. So you're going to price it off of trading derivatives. That was always the great thing about Bitcoin, right? It was priced off the actual exchange of Bitcoin. Now, unfortunately, we have some derivatives that, the banks have decided they want to make money off it by having derivatives and trying to control it. But the main thing is, as long as you're going to price it off the trading of derivatives, then the price is not determined by the metal and the value of the metal. It's actually determined by the supply and the demand of the derivatives. And right now, there's not that much demand for the derivatives because the hedge funds, the institutions, the usual buyers of the COMEX gold contracts or the unallocated gold in London, they're buying this transitory nonsense too. Oh, why would I buy that? Real interest rates might be negative 4%, but they're not going to stay there. The Fed has assured me they're going to go back down to, even or, plus positive real interest rates. So I don't want any of that gold. That'll wear off too once people figure out that this whole transitory thing is nothing but a ruse.
There are some derivatives involved in the Bitcoin pricing, and fortunately, because people can take their private keys, they can't ultimately win. But, at the same time, yields on 10-year Treasury have collapsed, and they soared, and they collapsed. If you take the adjusted dollar amount involved here between the $200 trillion bond market and the call it $700 billion Bitcoin market, the bond market is about 30 times more volatile than Bitcoin, Craig.
Yeah, isn't that funny? But see, again, and Max, I keep having to draw this back to where we began. The great people, and I mean it great, at WikiLeaks, free Assange. They have done more to support actual civil liberties in the First Amendment than anybody else. And they unearthed from December 1974, 3 weeks before the U.S. citizens were able to own gold again for the first time in 42 years, and 3 weeks before futures trading started, and those are not that's not a coincidence that they began at the same time. They unearthed cables from the Secretary of the Treasury in London, the Treasury Department in London, the Secretary of State in U.S. saying, we will form, the dealers expect a sizable futures market that will make it so volatile that people won't want to own it. And that's what they've tried to do to Bitcoin, to convince everybody, oh, it's so volatile. You don't want that. Oh, no. And the point you're making is fantastic. Heck, the 10-year Treasury note, Max, is supposed to be the foundational bedrock investment for institutional investors and central banks around the world. It's now moving 8 and 10% a day. How is that some kind of foundational investment? But Bitcoin moves $1,000 or gold moves 1%, and that's supposed to be risky and volatile. Everything's risky and volatile here as we get to the end of this monetary scheme.
Right, it's gaslighting. The mainstream financial media, unfortunately, is pay to play, and you can get them to say anything you want. You throw them a few quarters, and they'll spit up the lies. The Bloomberg had a headline: gold traders chat bragged about how easy it is to manipulate gold and silver prices. This has been with us now for years. There's irrefutable evidence that's been shown to regulators about this very thing, outright scam and manipulation. And it comes down to spoofing. And I guess, once again, let's review spoofing for those who still believe that these markets are freely traded, Craig.
The first thing people have to understand is, let me put it this way. The main guy that's been indicted so far is a guy named Michael Nowak, who was the head of precious metals trading for JP Morgan, but he was also on the board of the LBMA in London, okay? That right there explains to you how this stuff is hand in glove. The physical market, which most of it is unallocated metal, is in London. But that's where banks have to flow gold and silver to around the planet. Well, they know where the bids are, okay? And again, the price is set not by spot, but by futures. And so they work hand in glove with their trading desk in New York to massage the COMEX price, the futures price, so that orders don't get hit or orders get canceled on the physical side. That's how all these pieces fit together, Max. People think it's just some rogue traders. Maybe sometimes just to fatten up their bonus pool. But this is all part of the process of managing the price by these banks. And it continues to this day to think that some fines have been paid. What did JP Morgan get fined? $920 million? What did their precious metals bullion banking business make last year? $1 billion? So it's a slap on the wrist. It still continues. And I'll give you one more thing, Max. Back in the day when we first met, when I was just getting started at TF Metals Report, and we were in the, silver was spiking and the buy silver crash JP Morgan. I had a guy email me anonymously, and then it was credible enough that I always put some stock in it. And he said he was a former Bear Stearns trader, and he just had a whole bunch of things he listed out. So don't ever tell anybody I said this. Well, whatever, it's 12 years later. He said, listen, I read your site. There are all kinds of people that you mention and that your readers mention that they respect in the gold industry that are plants. He didn't name names, and I'm not going to name names, but they are controlled opposition. They are put out there to support a narrative that just kind of forces everybody to look away, to make sure no, it's not manipulated. It's a free market. Wait a second. How can you say that? Well, the sky's not blue, Max. No, it's red. Wait, I can see that it's blue. And so I've always fallen back on the position. Maybe that guy's right.
Right. It's all basically propaganda, and it's pay to play, and the price discovery is non-existent. We got to go. Craig, thanks so much for being on Keiser Report.
Always the best to visit with you, Max. Take care.
All right. That's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. Want to thank our guest, Craig Hemke of TFMetalsReport.com. Until next time, bye, y'all.